Thank you everybody for being here. And let me first of all start off by saying I had the pleasure of meeting Professor for lunch yesterday, and I sent that fact back to a lot of my friends in Bombay, and everybody said, "Okay, you met the board." So thanks for doing this. Thanks for doing this discussion. I'd love to start off with my own entrepreneurial journey. I think I graduated from a school which is kind of modeled on Howard. I am Bangalore, and the classes, everything looked very similar. Had a great experience there. But I think one thing which shaped my journey for the last 24, 25 years, I being able to start every time where there was something really adverse was something which has kind of shaped me over the last 24, 25 years. I graduated in 2001, was supposed to go to a company called Cluster Consulting in Barcelona. September 11th happened, got laid off before reaching there. And in some ways, it was the best thing which would happen because telecom and financial services consulting and just plummeted in Europe between 2001 to 2004. For me, one of the best place people in the batch. I went to be the last place person in the batch. And I ended up in Delhi in December '01 in a company called Kotak Securities. And that first, I think 60 days in a lot of ways shaped my life because I ended up doing cold calls to reach out to the wealthy clients. First, we tried to kind of really chase clients with Mercedes cars and car numbers. That experiment kind of failed. The next weekend, we tried to do something a little bit more innovative. We took a car and we started going around localities like GK2, Friends Colony West, Panchsheel Park, and noting down addresses of big houses because unlike Bombay, where a lot of the money was in capital markets, in Delhi a lot of the money was kind of visible. And I think that those 2 weekends really shaped my life in some ways. One thing I promised myself in business school is I never said, okay, I want to do consulting. And as life was to have it, exactly after 2 months, I was only selling. And the first 8 meetings, first 10 meetings, the firm was called Kotak Securities. All the 20 meetings we got of cold calls. Out of 20, 12 people actually thought they were coming from Kodak, which is the photo film company. Nobody really knew the brand Kotak in Delhi. The remaining 6 meetings were thinking we were coming from Kotak Securities as security guards. And honestly, my size didn't tell. So, and that year, just about entering the office, there was a big kind of stare from the security guard. But 2 or 3 of them worked out. And that really kind of shaped up. 2001 to 7, I spent at Kodak, decided to kind of get into the entrepreneurial journey. A lot of my friends are here from Bombay. I can see Apurva and Yogesh. And they're smart entrepreneurs. In 2007, ended up kind of doing some little bit of maths as a profession. And what I figured out is if I earn $100 for the firm, and those days wealth management was substantially transactional. If I earn $100 for the firm broadly pays you $15, 1.15. You pay taxes, you'll have to try about $8 or $9. The firm, on account of that 100, ends up spending another maybe potentially $35 to $40 to $45 on your boss, on marketing, and so on and so forth. So firms left with give or take $45, $50 pays tax. So broadly left with $36. So the equation was $9 to you and $36 to the firm. I was very happy with that because broadly it meant 1:4. And it also meant if I was to go out, I would nearly need to do a fourth of the business I was doing while sitting inside the firm, which is not possible because the client really wanted the entire platform to be there. So I was very happy being a professional. Came to Bombay and realized the world doesn't really work like that. The 9:36. The 36 gets multiplied by equation called the P multiple. And that obviously, in India, fortunately for all of us, still trades at 25, 30 times. So the 36 was becoming really 1,000. So the equation really became 9:1,000. It wasn't really 9:36. And that really kind of got me a little edgy again. And that's what got me to start 361 Wealth in April of '08. Again, couldn't get my timing better. Jan '08, I got out of Kotak. Got funded by a brokerage firm called IFL, which put in $3 million into the business to own 80% of the business in 2008. We were very sure we wanted to start with a full platform, so I didn't worry about diluting capital. But 2008, April again, ended up being a kind of similar story. 8 to 13, obviously life was tough. Getting a PD back in South Delhi, South Bombay was very tough as a brand. But 13 to 16, 17 was I'm going to fast forward a bit. Was a bit of a excellent journey because we started chasing clients who had a liquidity event. And at that point in time, a large pharma company sold its business to Abbott, ended up getting $1 billion, met all the pre-20 managers, chose us as the people to manage money. And that really kind of engineered us to focus on reaching out to clients who have a liquidity event. It could be sale of business, could be sale of real estate, your stock options for professionals. And at that point, everybody was willing to get or willing to meet everybody, and even willing to meet a new firm. So 2016, we had a state of a heavy growth. 2016, bought into BDRF, the big investors from the US, and General Atlantic in 2016 put in $125 million to own 25% of the business. And that got us to start both our asset management business and the lending business. Fast forward to 2020, 16 to 20 was fast growth. 2020, we decided to demerge the business and list it as a separate listed company in India. And as soon as I went to meet market investors, everybody said, great team, great execution, but don't love your business model. Business model is contingent to doing transactions, earning fees on transactions. And really, we love the business, but we won't be able to give it the right multiples. At that point, I think that's one of the decisions in retrospect, I feel most happy about. 2021, we changed our business model to move from transaction income to what is called recurring income. So effectively, what we did is instead of charging on transactions, we ended up starting on AUM. And I think that's really what public market investors wanted us to do. They're willing for us profits and revenues to kind of come down a bit, but they wanted to see the right business model. I think we do a very courageous call when we're listing in 21. The year of listing, we actually allowed our profits to come down by 30 to 40%, allowed our revenues to come down by 20 to 45%. But I think a lot of the investors rewarded us. They still came in and bought the stock. And I think 21 to 26, the advisory regulations came in it. And obviously, I think broadly speaking, the markets have grown by around 40% a year. So in some senses, allowed us to kind of get a natural benefit from the uptick. Fast forward to very recently, 6 months back, UBS has bought a small equity in our business. We've done a collaboration agreement. And today I think we've largely two businesses. Wealth Management, which is an open architecture advisory platform, and the asset management business where we focus on the alternates piece. And I continue to focus and work as an entrepreneur, professional entrepreneur, spend maybe 23 hours, 59 minutes on my business there.
Now, everybody speaking at HBS, yes, very good. So in terms of being someone who's cold calling Delhi mansions to now someone who has Bain Capital or UBS, some pension plan set on your cap table, a lot of folks in this room, aspire to be entrepreneurs. What has changed as far as you think about entrepreneurship over these years for you?
Yeah. Honestly, I think entrepreneurship is, the ability to take risk and hustle stays the same. I don't think that's really changed for us. I think that still needs to be there. What I'm really excited about is I think entrepreneurship is now broken into two parts. One is individuals like me, maybe who started out with really less camera. For them, there's a bigger platform today. I think the ability for people to raise money is relatively better. I'm not saying it's easy, but it's relatively better than what it was 15, 20 years back. And the second thing which I'm also equally excited about is I see a lot of my clients where India really did the economic reforms in 92. So if you really see most people have earned money over the last 50 odd years, it's only now you're seeing money being transferred from the current generation to the next generation. And what I'm also excited about is, and a lot of those families are also present in this room, money is getting transferred very well. So the next generation is really kind of study. Has a very, very good thought process of how to build business. So I'm also seeing entrepreneurship not necessarily facing the same kind of struggles that say I had faced, but also maybe kind of leveraging the platform you already have and using that to expand. So I think entrepreneurship would be of both kinds. I think there will be people who really kind of raise absolute bottom-up capital. And I think today, honestly, there's no real judgment between the two. Both are equally important opportunities.
In terms of an organization, and then I want to get a little bit into the more macro thing. You describe your firm as an elephant that can dance. What do you mean by that?
I think it's a business which requires a phenomenal amount of customization, and at the same point of time, it requires a huge amount of uniformity. And these are not things which we were born with. We made our mistakes, and we learned over the last 15 years. I think the client at the end of the day needs individual advice because everybody's asset allocation and liquidity needs is different. At the same point of time, 90% of the things he's doing, he's already kind of decided to do because he knows it's coming from, let's say, a firm which has done a lot of deep research on those ideas. So at one level, we have to be able to be customized and provide unique advice, and that's where the dance comes in. The elephant needs to really come in because the products which the clients are buying have to be so common. So we are today, for example, if I see a client's portfolio in, let's say in India, in Bhavnagar, Rajkot, or let's say in Houston here, everybody's portfolio would broadly look the same. Okay, asset allocation will be different. Okay, somebody will have higher fixed income, somebody will have a little less equity. So at the end of the day, I think while that's just one example. The same example goes to processes, automation, ability to service clients. So I think at a certain level, you have to be phenomenally centralized, and the ability to kind of decentralize it without losing the uniformity is very important because I think it's not as if even in spite of doing this, you will make mistakes. But obviously, the probability of making mistakes becomes much lower. And if you make a mistake, the size of the mistake is also small.
Yeah, one of the things in terms of the India's wealth story is moving assets from illiquid assets and the propensity you had, invest in real estate, gold, and given how prices of real estate and gold have gone the last year, how are you convincing people to actually get money into the capital markets?
No, I think both real estate and gold for India have been kind of natural preservation assets, right? So I think people have kind of naturally love to have both. But having said that, I think unfortunately, India is kind of divided into four parts or three parts of these. One's the ultra high net worth Indian. I think that India has kind of moved away from real estate and gold, maybe potentially a decade back. For them, real estate's largely been around consumption. Obviously, the prices have gone up because everybody's, especially post-COVID, everybody's propensity to consume has gone up substantially. So people want to consume wealth through their lifetime. So I think everybody's obviously going and buying a bigger house and a bigger house. And so I think in that sense, real estate prices have done well. But gold, obviously, I think all firms, including ours, have had a positive call on gold. But nobody's really had the right allocation there. So you're all at 2%, 5%, 6% allocation. So, but honestly, I think we're all super smart people here. But I think our rolling return based board still not going to be super attractive, right? So I think it's an at the point measurement. I think people will have 4-5% in gold, but New India, I think is very, very well diversified. On the financial portfolio, people have less than 15 to 20% on the fixed income side, potentially 5% would be on gold. Real estate, they don't even count as part of the investment portfolio. It's pretty much for consumption. At the remaining 75% but is diversified, 20 to 40% on the listed equity side, potentially 15-20% on the liquids. And everybody wants to have at least that 15-20% allocation to do with portfolios.
You talked about the ultra wealthy and then I would say the middle class, right? And then if you look at pyramid of Indian population, what about the aspiring middle class that are kind of coming new to financial services? Is that a target market for you? Should that be? How are you thinking about that?
I think we break up it has to be a target market. We break up our business into four parts. So one's the ultra high net worth individual, which is our core business. I think more or less fair to say more than $6 million of financial assets for us. And the second segment is something which is really a defense strategy. We can't have more. If it's a first-year partner at a consulting firm or somebody who's been 2-3 years at a private equity firm, naturally in his life cycle he will have that wealth. So you need to kind of have a defense strategy where you can't tell him, figure it out, wait for 6 years, get to that net worth, and then I would come to you. So I think that's the segment which is really looking at differentiated products also. The third segment is a big challenge, which is the aspiring middle class, which is really where the banks come in. And the retail banks like HDFC, ICICI would be doing maximum amount of business there because there the cost of acquisition is super high, and typically for them, everybody comes and opens a salary account there, so that the cost of acquisition there is lower. And there the needs really, the first three needs are a credit card, buying insurance, and potentially are taking a home loan. And these are three things which we really can't kind of compete on. So in the aspiring middle class, I think for good or bad, I think banks are going to be the first port of call. The moment you move a level up is really where we would kind of come in. And the last business is obviously the absolute, maybe maybe let's say $5,000 and upwards, which is where we bought a platform called ET Money, which is largely digital. And that kind of services maybe a million odd clients, more or less in the space of on average maybe $5,000 to $6,000. That's fully digitized. That's where a lot of change is coming through AI, ability to advise, ability to execute at scale. We don't do brokerage yet, but our platform is very clear in investment advice.
So, my colleague here, Derek, is also sitting here. So he and I, effectively, as a student of mine in a class called Leadership and Corporate Accountability, right? And we look at the class for 4 lenses, right? There's the stakeholders, our investors, customers, employees, and society at large. So take us through, what is the most difficult conversation you've had with an investor?
That's a great question, and I think honestly, if somebody asks me what is different about 361 and the way the company's emerged over the last 15, 16 years, I think the biggest difference is I think we manage. We typically say 3, but I'm going to extend it to 4. There are four stakeholders in every business, right? So I think there is one, obviously, the investor shareholder. Second is, let's say, the employee management. And third is the client. And fourth, let's say, the society at large, right? So all 4 are stakeholders. And, like everything else,
Only as if you were in an NCA class, brother.
But all 4 in some ways, need to be managed, right? I think it's a paradoxical statement because all 4 are always working against each other, and all 4 have to work along with each other. Because obviously, you'd have to the investor shareholder, you would love to pay nothing to the management. Left to management, they would take 100% of the profits as salary bonus. Left to the client, you would want to pay nothing to us. And left to us, we would want to charge everything to the client, right? So if all 3 of us are always working at paradox. But I think broadly speaking, if you cut across all the maths, I think 30 is a fair kind of number. I think most businesses end up with around about a 30% residual profit to the shareholder, 30% residual to the management team, and obviously I think 30% of the economics in today's old age business goes back to the client. And the last 10% goes to the society. I think so. In some ways, you have to figure out how to kind of share the economics in a way where we can kind of have all 3 as equal stakeholders. And if I think we can do that, I think new businesses like ours can get built. I think one of the foundations for us was really to share a fourth of the equity with all our employees. And as we even built the business, I think between us and my co-founder and all employees put together, we held a fourth of the business. But between the founding team, we had about 30% of that fourth. So we had around about 7.5%, 8% out of the 25%.
So now let's move customers as that thing. So, when you are like a caught-up client, I just want to understand, markets go up, markets go down. You don't always get a great return. What is the most, and I think the education of wealth management needs to be consistent investing over a period of time, sticking with your asset allocation. Take us through a really great conversation you had with a client and a very difficult one you had with a client.
I think, to be honest, I think client also in some ways comes second, right? I think first is really building the culture internally, because that's what really all the relationship managers end up with communicating to the client. And I think 3 things we really kind of talk about internally, which kind of expresses ourselves in our conversation with the client. I think first, we are very, very strong believers. No client comes to us for wealth creation. Okay, so everybody creates their wealth in their own operating business. So there's really no client coming to us with $1 million and saying make it 100 million. That's not possible. And we can't do it because it needs a return on equity in disproportionate terms. Let's put it high teens to mid-20s, which is not possible purely by investing. Obviously, investing is your business. That's possible, but otherwise it's not really possible. So I think the ability to understand everybody's not coming to us for wealth preservation. They're not coming to us for wealth creation, but they're coming to us for wealth optimization is very important. And that obviously leaves us in a zip code of 10 to 40% kind of returns. And so everything we do needs to kind of work around that, building an investment policy straight to the client, where we kind of moderate, not necessarily moderate his needs, but we kind of make him aware of what we would be able to deliver, what his pluses, what his minuses are. I don't know, end of the day, we understand if you all, I love to give this example. If you all could be Rip and Nickel, none of us would have the volatility of a 10-year bond and practically a volatility of, let's say, the S&P Nifty, maybe practically equal or close to equal 40 to 15 years, right? So theoretically, if you all could be Rip and Nickel and sleep for 15 years, we would all never do anything in bonds. We would just do everything in equities. Reality is, volatility is too much. And more often than not, in the middle, where we see the ups and downs, we kind of get up. We're not able to hold on for 50 years. So I think our understanding that clients will kind of not necessarily hold on with the positions for 15 years, and our own ability to ensure that they can digest the volatility, I think is a very, very important, very important understanding.
So you talk about the fact that you're focusing on your employees and your relationship managers. How would you describe the culture at 361?
I think the culture is threefold. I think one, I think we come from a very, very strong background of modesty, humility, and client centricity. I think these three things for us are very, very important. And I think we always talk about it as a company and as individuals. I think vision is more or less, I think, a overstated topic. I think sometimes a lot of successful, like, once you start feeling like that, it reflects in the firm. Sometimes people feel vision is 80% foresight and 20% hindsight. But I think in reality, all of us would agree. And even if I go back and look, I really did want to do 90% of the things I've ended up knowing. I think vision is honestly 80% hindsight and 20% foresight. And I think the ability to be able to kind of keep all your relationship managers fairly humble, saying, at the end of the day, we are agents. We are not really, the moment somebody starts feeling we are the ones who made money for the client, I think that's really where kids start going for a toss. So I think that's one. Number two, I think we love to say we are 24/7. So it's the firm is open anytime. I think one clear reaction we get from clients is if there's any query, they are able to get a quick response in 24 to 48 hours. So I think that's really important. And third, we really believe we want to be 360. So when we thought of the name, 360 was being able to kind of give a full 360-degree service to the client, and one being the client. So in some senses, so it's a good. And I think, as you said, we managed about a lot of money for pension funds, endowments in the US also. And I think they see us as a large boutique. So in some ways, they find us being large enough to have the right set of systems and processes, but being boutique enough to be able to kind of move fast to adapt to the needs.
So you talk about people, let's talk about technology, right? I mean, AI is the hot topic, and digitization got accelerated during COVID. That's when you actually set up 361 during that time period. How are you seeing the rapid changes in technology impacting your business, and how are you having it benefit your business?
I think one of those businesses, again, I think we'll have to kind of break it up as segment-wise. So I think the mid-market segment, the mass affluent segment, and the ultra-high-net-worth segment have different impacts on technology. But I think for all, in India is a slightly different case from the US. I think we've always been adopters and innovators. We've not really been inventors. Okay, so if I just go back even to technology 20 years back, and even if you look at AI today, we're not really at the cutting edge of developing AI. But at the same point of time, they're very good at adapting and innovating. Okay, so I'm about that pessimistic on India. I think we'll adopt very, very well, and we'll adapt and innovate also. So I think for us, honestly, if you ask me, I think the lower end of the segment, which is largely going to get brokerage and self-advice, I think that's where we're going to see tremendous amount of change because of AI. As you move towards the ultra high net worth side, I think it's going to be AI augmentation. And I think it's augmentation of AI which is going to improve the service to the client. So I doubt in a very, very short term, all our large ultra high net worth clients will drive or take decisions just looking at outputs coming from AI. They still need a certain amount of discussion, ability to kind of adjust to their mindset. But AI will be assumed to be able to augment their decisions. So I think firms like us would really have to work hard to ensure every process of ours is augmented by AI, as opposed to necessarily big AI itself.
Yeah, I mean, one of the things we talk about class over here is AI, artificial intelligence versus artificial judgment. And whether you can actually, AI can place judgment in a way or not. We have debates in our various forums for that. In terms of the customer and then the regulations, so let's just talk about that from your perspective. What regulatory changes do you think need to happen? I mean, everyone is very complimentary that, we are the fastest growing economy in the world, 6-7%. But ultimately, if you could actually do the math, 6-7% growth is actually perhaps not even enough to absorb the flow of talent coming into the job market. So as one of the efficiencies is the fact that we don't have enough capital formation. So as a more macro level, as a big player in the market, what would you advise um, in terms of regulatory changes and other things that need to happen to accelerate this?
Oh, I think, to be honest, government's done a fair degree of work over the last 5, 10 years. I think we've come a long way. I think I'll break up regulation into three parts. I think one's the entire financial market regulation. I think there India would score 11 on 10, not even 9 on 10.
It's too much.
There's too much, but good. But I think every client's, every stock, every bank balance, everything's segregated at the end of the day. So you're not really you cannot any intermediary goes bankrupt. The client really doesn't need to kind of even wait for 48 hours to get access to his. I don't see this anywhere else in the world. So in that sense, they've done really well. I think in terms of alternates asset management, the regulator has been super fast. We came out with the regulation in 2017. Fast forward to today, I think we'll be at par with pretty much every developed economy, including different asset classes, ability to make segregated investment rate bills. So all of that is happening. I think 2 or 3 things we could potentially improve in terms of capital formation. Right? Reality is, as jobs are at a peak, we brought a huge number of people a huge number of our youth coming into employment every year. I think somewhere maybe, and sometimes we need to kind of, so for example, we have taxes on foreign capital, right? So that's not something which most of the economies have. But I think in its own way, we've had a bit of a background where we had situations where money kind of got round tripped. That's maybe 20 years back. But I think that's something maybe we have to do a little bit more to attract foreign capital. That can lead to a lot of development. Not that we're not attractive for capital. I think we brought phenomenal amount of capital from places like Canada coming into most of our real assets. So whether it's roads, whether it's infrastructure, Japan's been a big supporter in terms of capital. US obviously has again been a phenomenal supporter in terms of capital, but that's largely US at the border growth cap. So it's more into private equity, more into listed equity. I think the third thing the government can potentially do is maybe we need to figure out how to fast track our capex, domestic capex. So I think domestically, Indian market has become very strong from a savers perspective. So if you see the last 18 to 24 months, large amount of the net flows have really come from domestic investors. But we need to figure out a way to convert that into capex. That's not really happening. And because capex is not happening domestically, I think a little bit of the job formation is slightly lesser than what we would want.
And why do you think the capex is not happening? I mean, again, I think people talk about the ease of doing business in India, and that's not
It's a multitude of sub-local, global factors, right? It's too many things come into it. I think there's always China as an angle. China is obviously manufacturing in China is facing a huge amount of surplus. How do you kind of ensure that doesn't kind of find its way into the country? Obviously, execution sometimes takes longer than what you need to take. So the project cost of capital kind of moves up. Lots has been done, but we really can't say you're right there. Yeah.
I'm going to ask one more question, then open it up. So if you have questions, please think. So one thing, the 361 CSR activities also, and you talked about your responsibility for society, and that's important for you. Take us through, and you've done some innovative structures around blended finance structures. Perhaps take us through your thinking about how we bring not just the top couple of 100 million people into the system, but really focus on financial inclusion and other aspects of bringing everybody up.
Well, that's a big focus area for us, and honestly, I think we spent a lot of time over the last 4 to 5 years trying to build it out in a very methodical manner. I think we have one big advantage of doing CSR. We're connected to an ecosystem of maybe potentially 5 to 10,000 families, all of whom had the ability, most importantly, to contribute in a very meaningful way to CSR. They are the people in the country who can make a difference. The most important thing today, I think, a big change, again, over the last 5 years, everybody wants to meaningfully contribute to CSR. They necessarily don't know how to do it. So I think that leaves us with the responsibility of trying to build a CSR program where everything we do, either through 10 times or 20 times that amount. And obviously, I think in that regard, things like, we're working with some of your NGO platforms also, especially things like, first loss capital, returnable grants of working capital. Those things really kind of go a long way in being able to kind of have an exponential impact as opposed to a arithmetic impact.
So that basically using linear finance structures to, multiply the capital impact of your client and yourself. So let's start with some questions. We can start, at the mic, yeah. Please keep your questions short so that, thanks.
Hi, Karan. My name is Subo. I'm not at this business school, but I go to NYU still.
Just a little bit louder, please.
Sure. My question to you is, other than technology industry, what industry are you most optimistic about in India?
Great. I think, honestly, I'm excited about 5 industries, to be honest. So it's not one industry, but financial services, obviously, I think continues to grow. GDP continues to grow at 12% in kind of nominal terms. You will see the financial services industry growing at any ballpark rate of 40 to 80%. Obviously, that be with us and lose us, but I think the broad industry continues to grow. Financial services, consumer, tech services, industrials, and which one I want to say, healthcare. These 5 more or less consume 90 to 95% of the entire investing framework in the country. And I'm honestly would struggle to believe any of these 5 won't do well. But if I was to pick one, I think for the next 2 to 5 years, I think within industrials, there's going to be a lot of movement. I think a lot of focus from the government also to kind of increase capex. And within industrials, things like defense, all the way to manufacturing, we'll see a lot of growth.
I just on that, go to the next question, on tech services specifically. Here, Hollywood, there's a lot of talk that AI actually going to have a seriously negative impact on India's tech and software industry. What's your thought on that?
I think there will be some impact for sure. I think it's not possible there is no impact. But like I said earlier, I think we've been very, very strong innovators. Okay, so I think I think AI needs a lot of work to happen at the back end, and especially when things become complex, we move into security, we move into different degrees of storage. I think AI is also some time away from becoming that smart. And I think honestly, everything will get replaced. I think hopefully we are able to adapt, but adaptation will be needed for sure.
All right, maybe just the gentleman and then a couple.
Hi, I'm Pritham. I'm a student at NYU. I study real estate. My question is we talked about gold and real estate. Most of our household wealth sits there. And how do you think we can help these people invest? You are in wealth management, invest in stocks. I know people doesn't understand markets here, but bringing this capital or liquidating some amount or leveraging it and making them invest in the markets can help more companies get capital and being liquid, or more companies going back to you.
So how do we actually create?
I think lots have happened. If you see, I think REITs and InvITs in India have been super phenomenally successful. So you now have nearly five really large REITs in India. And as I think each of those REITs have maybe $3.5-4 billion each. So that gives a really nice fractionalized way for everybody to invest in commercial real estate. All of our clients would love that. We would be practically all our clients put together owning nearly 10 to 50% of each of these REITs. So that's a clear example of how access to capital to companies will be available in a fractionalized format. All companies would not be large enough to get listed because the capital markets is vibrant, but still requires it to be of a certain size. But I think if you look at any yield asset today, whether it's commercial real estate, whether it's hospitals, whether it's potentially residential real estate, roads, everything could be fractionalized and converted to a REIT and InvIT to be able to raise capital. So I think that from a regulation perspective, there's a lot of leeway.
Yeah, I think his question also was about the fact that apart from under high net worth, a lot of people still have fixing a big part of their net worth in gold and real estate, which may not be the consumption, and that they move that in the financial markets.
I think a lot of it has changed, to be honest, but these are going to be, they're not going to be delta changes. They're happening every year, every month, every day. Okay, so I think, again, maybe I'm a bit of a conservative guy here, but honestly, I believe incremental is exponential. There's nothing called exponential. Okay, so I think every day there's a lot of change happening, and by the end of the 365th day, there's a lot of change happening. So I think, in that sense, I would say 10 to 15 cities in India are largely converted. I think last 3 years that 10 to 15 has become maybe 35, 40 cities. But will it become 100 cities tomorrow morning? The answer is no. But will it become in 18 to 24 months? I think bold real estate will continue to be a smaller and smaller portion.
Okay. Let's there's a gentleman right back there now.
You're sitting on a coal mine, and not in terms of financial terms, but observing patterns of human behavior who have been extremely successful. Those alternate high net worth like you is one. Have you noticed any kind of a patterns of behavior or anything like three things you observe across the sectors that has been made them very successful?
I think from a patterns perspective, the first pattern obviously is I think people have become much more bolder over the last 5 years as compared to earlier. So I think people are willing to take a little bit more risk, especially as the next generation is coming into business, which is a very positive thing. And I think that is going to translate itself in many ways into different. We discussed capex a lot, but that I think will kind of get done on the next 5 to 10 years. I think the second thing is there's a lot of more culture to give. Okay. Give and spend, okay, both. It's not, so people necessarily want to save lesser, but they also want to substantially give more. And third, I think, generally speaking, people are spending much more time in getting educated. So I think education, training is substantially, even people who are super successful may have become really large financially, but want to spend time to kind of get themselves abreast of what's happening in the world.
Yes, ma'am.
Hi, Payushi. Thank you for being here. My question is, where do you think technology genuinely improves advisory, and what are the verticals where human judgment will remain irreplaceable?
I think technology will improve advisory everywhere. Okay, so I think every aspect of advice can improve with technology. At the end of the day, advice is based on the patterns, empirical data, information, and every conversation. So, for example, we have an internal AI tool which captures every conversation you had with every company, every fund manager, every decision you made post that conversation. So, I cannot say that technology will not improve every part of advice. Okay, I think judgment's still going to be super important because every client's very different. The client's not a robot. Okay, so he's going to behave in a very different manner every time. And at the end of the day, it is our own ability to sit in front of him or even on a Zoom call or whatever, be able to understand how he's going to be able to react and kind of navigate his decision making for his best needs. So I think judgment will always be there. In pure investing, I think that's where I think judgment will become lesser and lesser. So I think as a portfolio manager, I think judgment, which used to be maybe potentially 70 to 80%, will come down to 20-30%. And your AI in that sense. But as a relationship manager of the wealth management side, I think judgment will still kind of. So if you ask me for the asset management business, I think judgment kind of comes down a little bit. But for the wealth management business, I think it continues to be a large component.
Okay. Let's go that side over there.
So, we see lately,
If you speak the mic, please.
US is out of the zero interest rate period, and India's currency is straight into the 90s, approaching 100, bit negative. But do you see a business opportunity for a B capital to be invested outside? I know it's 360, or you guys evaluating themes in that space?
I think India's done a lot for capital to be invested outside. I think let's kind of break it up into two parts. One is obviously capital which you can send out theoretically for any purpose and never get it back to the country. I think there RBI is very careful of not increasing the limits beyond $250,000. And I think that's the limit for the last maybe 8 to 10 years. I don't see that changing dramatically. Having said that, obviously they understand and they appreciate that individuals want to diversify their portfolio and invest overseas. So that's why I think the new rules around gift silly are very, very good. Through gift now you can send out 50%, 50%.
Right, just say gift cities on.
Yeah, gift city is basically like a zone in India which is outside India. So it kind of gets qualified as a foreign zone, similar to let's say what DIFC is to Dubai. So as soon as you send out money to gift, you're sending it out to a foreign jurisdiction. And obviously there are a little bit of tax benefits and so on and so forth that you set up in gift. But through gift, you can send out 50%, 50% of your net worth of a private limited and a partnership company for investing. The only caveat is when you redeem the money for the redemption, the money comes back into India. So it's a portfolio diversification. It is not permanent money being sent out. So I think India has done a lot in those aspects. And honestly, I think Today we are seeing a trend where clients would at least want 5, 10, 50% of their portfolio to be invested overseas. But does that mean they can send the money permanently outside? I don't think so. And obviously we've seen 2.5%, 3.5% depreciation of the rupee pretty much every year for the last 15, 20, 25 years. And that's largely a reflection of the gap at the interest rates. So I think that continues. And I don't, unfortunately, if you ask me, I fear convertibility of the rupee would be better, but I don't see that happening in a very short period of time.
Okay, we take one last question and Karan will be around for a little bit. So sorry, your hand is up. Come on.
Yeah, I'm Rashid. I recently graduated from there and currently working with a climate PC firm. My curiosity was, in India particularly, how are you looking at ESG when you're advising your clients? And the world seems to be like divided. In one hand, we have ESG backlash. In one hand, we have like these European countries which are pro-ESG. So, I mean, the three parts of the question would be like, do you think it is important for an investor to be conscious about that? Are your clients already sensitive to that? And what are the underwriting strategies that you're obeying in terms of fulfilling that requirement?
To be honest, I think investors are not super conscious of ESG needs. Obviously, that doesn't mean as a firm we are not conscious. We do run a few ESG portfolios, and then there are obviously certain parts of it there where people don't invest in, let's say, hotel businesses or businesses which have tobacco and so on and so forth. But honestly, I think purely driven by ESG sustainability, I think it's something which we all like to maintain. For example, I think we would try and maintain for all our portfolio companies, we maintain an ESG score. I would try to be closer to the late 80s to the early 90s. Is that something which really drives client's decision today to invest or not? I don't think so. We've reached that maturity. But as portfolio managers, are we conscious? Do we want to be at companies which can be the late 80s to the early 90s from an ESG score perspective? The answer to that is yes.
Yeah, we had a lot more questions, but Neha's standing right here with me. I'm going to wrap it up. I had some rapid fire questions for you, and I'll keep those. So I think, is it okay if you be around maybe a people? Yeah. But let me okay. Let's have a video.
At the heart of every nation is a special tribe, one that breaks in change constantly, one that spreads the roots of success deep into the furthest corners of the country. Individuals who are always walking ahead of their successful yesterdays, taking the nation along with them on their extraordinary journey. Extraordinary journeys need extraordinary partners.
Well, that's a fantastic good one. Thank you so much. Their entrepreneurial journey, for sharing your entrepreneurial journey. I think for a lot, since I guess the average age here is pretty young, I think you're an inspiration to all of us for having started from scratch to build a huge business like this, and all the very best for the future. Thank you so much for joining us.
So, to love you, bro.